Capitalized cost of long-lived tangible assets with finite useful lives, such as building or PPE, are allocated to subsequent periods via depreciation expense. This video examines the financial statement impact of choices about different depreciation methods on current profitability and future earning trends. The depreciation method chosen should reflect the pattern in which assets' future economic benefits are consumed. Accelerated depreciation methods such as double declining balance method result in higher depreciation expense or lower net income in earlier years and lower depreciation expense or higher net income in later years. Straight line depreciation method results in an even depreciation expense over the life of an asset or smooth net income. Let's look at an example. You are analyzing two companies, Evenly Corporation and Sooner Inc. Each of the two companies buy an identical piece of box manufacturing equipment at a cost of $2,300, and each company estimates the equipment salvage value of $100 and useful life of 4 years. However, each company uses a different method of depreciation. Evenly uses a straight line method, while Sooner uses double declining balance method for the first year, switching to straight line for the remaining years. Also assume that each firm generates $3,000 in revenue and incurs $1,000 in expense other than depreciation expense. Since Evenly uses straight-line depreciation method, its depreciation expense will remain the same for the entire useful life of the asset and is calculated as follows. Cost of asset, which is $2,300, minus the salvage value, which is $100. This gives us $2,200, and dividing this number by the useful life of an asset, which is 4 years, gives us a depreciation expense of $550 per year. Sooner uses double declining method for the first year. The depreciation expense for this year will be calculated as twice the depreciation expense if we were using straight line method, ignoring salvage value. So if we ignore salvage value, the straight line method will result in depreciation expense of $575 per year, which is calculated as $2,300 divided by 4 years of useful life. So the depreciation under double declining method will be 2 times $575 or $1,150 during the first year. For the remaining 3 years, Sooner follows straight line method. So the depreciation expense will be $2,300 minus $1,150, the amount of depreciation already claimed during the first year, minus the salvage value of $100. This gives us $1,050. Divide this number by the remaining useful life of 3 years, we get the depreciation expense of $350 per year for the remaining 3 years. Now let's calculate the net income for the two firms across 4-year period. Because revenues and expenses other than depreciation are assumed equal in each year, Evenly, which uses straight line depreciation, reports the same net income for each of the 4 years. Sooner, which uses an accelerated depreciation method in the first year, reports lower net income in the initial year because its depreciation expense is higher in that year. This company shows a positive trend in income. So a newly hired CEO will have a strong motivation to use double declining depreciation method during the first year and blame the poor performance in the initial year to the old management. This will result in higher profitability in the future periods in which he can claim a bigger paycheck. Similarly, a CEO close to retirement will have a strong motivation to use straight line method and boost current period earning to claim a larger compensation. Note that the cumulative net income, which will be $3,944, is the same over the 4-year period for both companies. In the next video, we'll talk about the different inventory valuation choices and their impact on profitability.